Hi, everyone. This is Matt Curfman with the Richmond Brothers for another edition of Matt's Minutes in January of 2022. The day of this recording is actually Friday, January 21st. I know it's only been a couple of weeks, but there's lots going on, so I thought it might be good for us and our team just to touch base. Hope you're all staying as healthy as possible. We're hearing from clients around Michigan and around the country. Lots of still health concerns. So there's a lot of COVID related issues still affecting people in the economy out there. So that's certainly one concern that also ties back into financial markets and the overall economy. The other is probably rising interest rates. Look, it's been a long time since we've been in a rising interest rate environment. And one of the benchmarks that you look at is the 10-year Treasury, the government bond. So started the year, this year, 2022, at 1.52%. That's the yield for 10 years. It's about 1.83% right now. So that 0.3% increase in the last 3 weeks is a pretty big percentage increase. And so that gets the markets a little jittery. That said, if you go back to 2020 in the first quarter, right before everything kind of unfolded in the US and globally with the pandemic, the 10-year Treasury started the year 2020 at 1.92%. And so we've kind of gotten all the way down to about 0.5% back in the spring of 2020 when the pandemic was unfolding and shutdowns were being forced. And all the way back up now to 1.83%, which is still just slightly under where we started before the pandemic. So I just think it's important to take a step back and have that context. The other thing is as the Federal Reserve looks to raise rates this year, that just means money isn't as cheap as it once was. And think about this from a simple standpoint. If you were buying a house and you needed to take a mortgage on the house, lower interest rates means you can either afford more house or you can just have a cheaper payment. So the cost of money is a lot cheaper as rates are low. So that's what we talk about when we say money is cheap. And so you think about that from a business or corporate standpoint. As rates go up, if companies borrow money to expand growth, spend on research and development, they can borrow at pretty cheap amounts. Just in talking to a lot of our clients, perfect example would be in the automobile sector. If you were buying or leasing a new car, loan rates are sometimes at 0%. Well, that's pretty cheap money. And so you might say, why would I pay cash up front if they're not going to charge me anything to finance it at 0%? So as rates go up, we start to question those same decisions and think about that on the corporate level and in much bigger dollars than you and I think individually probably. It's not a terrible thing. And again, if you take a step back from all of the noise, interest rates would be being raised by the Federal Reserve because the underlying economy is getting stronger. I'm going to say that again. Interest rates will go up because the underlying economy is getting stronger. So if you cut through all of the noise and all of the headlines, just remember that fear strikes a balance in headlines and news and media outlets. So you tend to see more fear-based articles and headlines that basically compounds on itself, fear essentially. So as rates go up, keep in mind that's good for the economy. That may mean in the near term, it's going to be a little choppy in the overall markets. This is why when we talk to you about your risk score and your risk tolerance, remember the scale is 1 to 99. And having investments on the risk side of a 1 to 10 to 25, those are there. Those would be names like, for example, fixed indexed annuities possibly. Some of the fixed income categories, maybe some Guggenheim names, for example, in some of your portfolios. Those are there meant to stabilize the risky side, which is really where we're seeing a lot of that choppiness at present. Being from Michigan and being in the Midwest, we're used to snow, ice, freezing rain, and cold winters. We've had a pretty mild winter, but a quick analogy that I just thought of when I woke up this morning as I was thinking about preparing this video for all of you. Imagine that you were a snowbird and for the last 10 years, you didn't see snow or ice. You went down to Florida or somewhere south or west for the entirety of winter and you never experienced any of it, but yet you grew up here. So you come back on the 11th year and decide, I'm going to spend the holidays here with family and friends. I'm going to kind of stay and hang out in the snow. The first time it snows or freezing rains or gets icy, driving conditions are always a little choppy, and it's kind of like riding a bicycle. Once you learn, you pretty much never forget. But in the early days, it takes a little while to catch back up. So I guess I would attune that to rising interest rates in this economy. We just haven't had hardly any environments in the recent handful of years, even up to a decade, almost a decade and a half, where there's been any hint of rising interest rates. So it's not something we're used to, but it is a good sign economically. So there's a lot of noise right now. As I pulled, just to give you an idea, year to date through the timing of this recording, the Dow Jones was off about 5% year to date, the S&P about 7%, and the NASDAQ about 11%, just from the January 1st numbers. So I don't believe, and we do not believe, that technology and innovation is going away. We don't believe that we're tipping into any sort of recessionary. Keep in mind that from time to time, corrections, which would be viewed as a 10% or worse drop from the top previous high, are healthy for the long-term benefit of the market and really all of us, even though they're not comfortable to go through. So let's keep talking about your risk scores. Let's keep managing to your comfort and your tolerance level. And that is what we're here to help guide you through. You hear names and terms in the headlines like a market tantrum. So what does that mean? Well, think about, if you have a young kid or grandkid, or even think back to when you were young, something didn't go your way. We pouted a little bit, we cried, we had a temper tantrum. So that's as simple as really what that means when you see that across the headlines. So we're here to help guide you through all of this. There's just a lot of divergence right now. And outside of some of the really, really big tech names, for example, January 14th, I saw an article in Financial Advisor magazine where 2 weeks into the year, they looked at the NASDAQ and looked at tech stocks, and 36%, so over a third of the stocks that make up the whole NASDAQ, at that point were down more than 50% from their previous highs. Those are pretty significant swings. This is where balance and some of the mutual funds or exchange traded funds, help provide a little bit of downside protection there. So we are all here for you. Please stay as healthy as you possibly can. Don't hesitate to reach out if you have any questions, and have a great upcoming last week in January. As we move into the next 2-3 weeks and we go into kind of earnings cycle, we probably need to get through this and see actually the underlying health of some of the companies and the financial strength of these businesses. But don't be too afraid of rising rates when you hear that affecting the overall markets. Thank you so much for tuning in, and make it a great day.